strategy selection. This is important now because now I'm going to take our contextualizing positive drift and put it into strategy selection. Yesterday, we addressed the key statistics and conditions for selecting an underlying. Today, we're going to turn our attention to strategy selection and what to do once you've chosen that underlying. And again, this is a generalization.
Correct.
Don't look at this and say, hey, you know what? Live by it, breathe by it. This is just everything we do here is just to get you on the right kind of footing, and then you have to adjust. I kind of compare it to somebody that goes skiing, and you get to the mountain. You really don't know what to expect snow-wise.
Correct.
It may snow the night before, and you have this nice soft powder. You don't know.
It might snow the night before, and it's really icy. And
it may rain. It may be icy. It may be packed. It may get slushy later. You just don't know. And so you're going skiing, just like you're going trading, but you just don't know what all the conditions are.
Right.
So you have some generalization. Hey, the objective here is to get down the mountain.
Right.
And have some fun doing it. But I just have to see what the conditions are. Yesterday, we just did this. Go to the next slide. When implied volatility is a major component of our underlying, it is also the primary factor in our strategy selection process. First, we'll look at where IV sits in its range, and then we'll compare it to the overall market. Because what we're doing here is we're trying to build a basis, okay? We're trying to say, hey, you know what? And again, I'll make another skiing analogy. The conditions are beautiful, okay? But you have to make a decision at the top of the mountain. How hard do you want to push yourself? Do you want to push yourself down the mountain, down something that's really hard and test yourself? Or are your legs hurting?
Right.
You just want to have a fun run.
Right.
Okay, you have to make these decisions in every aspect of your life, but we don't necessarily do it. We think every single time we make a trade, we're going to hit it out of the ballpark.
Correct. It's exactly the same.
That's correct. Let's go to the next slide. So, for example, if the market implied volatility is trading at 25% and we select a stock that's trading at a higher volatility, let's say 40%, we will choose a strategy that looks to take advantage of the volatility/premium. Okay, volatility, we can translate volatility into expected move. We can translate volatility into kind of time premium. It's just a big, it's a big catch-all for whatever we're looking at.
Yes, I agree.
It is a catch-all.
Right.
It's a catch-all for expected move. It's a catch-all for time premium. Let's go to the next slide. The reason we look for more volatility in stocks as compared to an index or a market is the non-diversified and binary nature of individual stocks. As such, we would always rather be short an individual stock opposed to an index. One of the reasons that we like really rich implied volatility is because it lets us migrate and transition to an underlying that doesn't have nearly as much risk to us.
Right.
We feel much less comfortable with bigger positions in stocks like Tesla or CMG than we do in stocks like the spiders.
Sure.
So if we could
or any
sell
other kind of liquid ETF like that, right?
if we could sell 30% implied volatility in the spiders with a huge strike selection, lots of marketplace efficiency, we won't even look at another stock.
Correct.
But right now we don't
Wouldn't
have
need the equities at all.
Right now we don't have that opportunity. So
we
we
have
look
exactly the opposite.
That's right. We have an extraordinary amount of risk with respect to reversion of the mean in diversified products, so we look to other things that have lots of kind of cushion.
Right.
Again, one last skiing analogy.
Oh,
One last skiing analogy.
are you planning on a ski vacation
No.
this year or something?
Maybe, but no right now. Last ski analogy. You go to the top, you go to any mountain, and especially in like Colorado or Utah, wherever it is, and you get to the top of the mountain and you see these guys or gals walking up a higher than the top lift goes to.
Sure.
So
Go
above
to the basin.
above everything else, there's like a catwalk or there's some kind of way, some trail where you can take your skis off and you can walk up because you can have 16 seconds of glory coming down some chute that you either kill yourself or you get, or you have the fun of your lifetime.
Sure.
You're a thrill seeker. And for me, okay, I'm not going to walk up to carry my stuff up to that chute. Okay, so I'm going to opt for the more liquid underlying. But there are different times for certain skiers, and there's different times for certain traders when you know what? You just want like walking off the top of that chute is like taking your shot in Chipotle last night.
Yes.
to a certain extent.
Yes.
And what happens is you have a thinly traded stock, you have this very rich implied volatility, and you say, you know, I'm just going up the top of that damn mountain. And I am going to walk up there and I'm going to have 16 seconds of fun. And it's going to take me 3 hours to walk up there. Really, that's what it does.
I know.
And in the end, you go, that was the greatest 16 seconds of my life.
That's
like-
like,
it's
you
like-
just take the helicopter in there.
Hey, it's for people that do skydiving for that kind of thing. They go, it took me 8 hours to take the class to, learn how to use everything. And I had whatever it is, 11 minutes of fun.
Right.
And it was worth every dime of it.
Sure.
Now, I'm not going to do that.
Nor am I.
Here, so let's look at some strategy selection here for a second. So we picked some dates, 7, 18, 10. We basically just went back in time. And we looked at different symbols, the spiders, Apple, Lulu, whatever. We looked at price, we looked at implied volatility, and we looked at implied volatility percentile. So just Tony, let's just take a walk through this. The spiders with implied volatility of 14% and the implied volatility percentile at 19% versus Apple on the same days at 20. That's currently. That's yesterday.
current today.
Yeah,
Correct. Or
But
yesterday.
just kind of go back in time and look at the different relationships between these. On 10/31/08, which was kind of right in the heat of that meltdown, the implied volatility was 50, almost 60%. Cisco was 67%. The volatility percentile was 71 and 90. And there's no question, okay, which one we're trading.
Correct.
I mean-
you'd rather go into the SPY in,
Of course.
in 2008.
Of course, and if you go back and you look at the even with respect to Lulu, there's no question which one we're trading.
Correct.
But right now we're trading Apple.
Correct.
Okay, because we're just using implied volatility as almost a stepping stone into strategy selection as it compares to different broad-based index. Let's go to the next slide. And again, we archive all this so you can see it all. When volatility is high, strategies to consider, because you guys asked for this kind of a market measure segment so that you can grasp everything. When volatility is high, strategies are to consider selling strangles, selling iron condors, selling credit spreads, those are sell verticals, doing covered calls, doing naked puts. Okay, these are all strategies that have a relationship with high volatility. And again, just to become consistent. Strangles, more money, wider strikes. Iron condors, not more money, but wider strikes.
Further away from the
Verticals,
stock.
not more money, wider strikes. Should they be wider strikes? Of course.
Wider strikes means same with the strikes, further away from the stock.
Further away. Covered calls, lower cost basis, because high implied volatility means lower prices. So covered calls, lower cost basis, higher premium on the calls. Naked puts, same thing. Lower strikes, further away out of the money, higher premium you collect, much better return on capital. The thing with strangles is when volatility is high, your return on capital relative to the amount of money you're going to use is a huge improvement. In fact,
Because that doesn't change, right? Usually the
no,
margin
it goes lower.
Right.
So remember, when you sell strangles when volatility is high, the market's cheaper. So what happens is you're selling strangles on cheaper stocks, you're putting up less money, and your return on capital is greater. So again, all of these, except for iron condors and verticals, offer a higher return on capital using less capital. So you use less money and you get a higher return on money, significantly higher. That's why they're interesting. The iron condors and the verticals, you just go further away from the at the money strike. Let's go to the next slide. As premium sellers, strategy selection in a low implied volatility environment is way more challenging. However, it's important to stay in the game and stay engaged. We do this by widening out our strikes and focusing on underlyings that maintain a rich implied volatility. And that's the challenge. That is the binary event challenge that we faced last night with Google. That's the binary event challenge we faced with CMG or any other stock, or with Microsoft. And you know what? Sometimes it's all luck.
Of course.
And don't think it's anything but, and don't get focused.
But you could make more luck with higher volatility than you can with lower volatility.
You can make more luck by just having general market awareness. Listen, is it lucky that we picked CMG to be perfect? Is it lucky that Google stayed inside the range? Of course. Is it lucky that we didn't pick Microsoft at all? Is it lucky that we didn't
But it
pick...
wasn't luck as in random luck.
I don't think it was random luck at all.
Okay.
Was it lucky that we didn't pick ISRG at all? I mean, we did things because we have a set of mechanics that we stick to.
Thank you.
ISRG was way too inefficient price-wise, so we stayed away, and it proved to be the right move. Google and Chipotle were much more efficient. The most efficient of them all was Microsoft, but we couldn't find any edge. So we stayed away from the most efficient and the least efficient, because the least efficient, we didn't think, we just didn't have any feel for it, because it just didn't give us what we felt was accurate readings, and it wasn't. The most efficient just gave us a situation where we didn't like the risk reward.
Correct.
So we went for the other two. That's all part of market awareness. That's all really important stuff to take takeaways from here. Let's go next slide. One key factor in selling premium during low implied volatility environments is to protect against a sudden rise in implied volatility. So if implied volatility is low, look to places that won't be negatively affected by a sudden volatility expansion of the market. Strategies such as diagonals or pairs trades are good choices. Having a position like we did yesterday in the VIX, that was part of the reason. We essentially, I don't want to say we bought volatility, but it's pretty damn close.
Correct.
Closest thing we do, we get to it.
You mean buying a call spread in the VIX, yes.
Diagonals are interesting because they like higher volatility, just like calendars. And then finally, pairs trades are good because they allow you to extend your duration while reducing your risk. They just don't give you a statistical any statistical edge. Next slide. Strategies to consider when volatility is low: bearish directional trades. Because listen, I'm short Citigroup right now. I don't know what Citigroup's doing today. It's down 17 cents. I'm short Citigroup today because implied volatility percentile is 0. So that's why I have a bearish directional trade. A put debit spread in the money, one strike in, one strike out, a pairs trade again, or potentially a diagonal to take advantage of a directional diagonal, lower prices, higher implied volatility. And the pairs trade, you can skew it a little bit to give yourself some directional edge. Somebody called in yesterday afternoon. They said, what about NASDAQ versus S&Ps? And we joked 30-1. We were pretty good.
Would have been pretty good, is right.
Let's go next slide.
2-1 works out just fine also.
Other factors to consider regarding strategy are POP and ROC. POP, probability of profit; ROC, return on capital, both for individual traders as well as the portfolios as a whole. I'm not going to sell a put if my return on capital is 1.5%. I'm not going to do something where my probability of profit does not fit my overall portfolio. So let's keep hammering this stuff home, both for individual trades as well as the portfolio as a whole. The general rule: we place high probability probability of profit trades while attempting to maximize ROC. On a weighted average, we look for a portfolio to have a probability of profit somewhere 60s, low 70s, 65, 75, if I had to pick one.
Sure.
In this current market, 60 to 70. And if the volatility gets richer, a little bit higher.
Very good. Last slide.
Last slide. Sorry, I went a little bit over. Dave, I apologize. In summary, after we've identified potential underlyings to trade, we look for strategies that take advantage of the implied volatility premium while looking to maximize our pop and rock.
Very good, sir.
It's a lot of information. I'm sorry that was 22 minutes of...
But that's good. A lot of people are looking for what strategies to look in what volatility environment. You just gave them to them pretty much.
The other day when we had Glassman on the show, they make the case both written through radio, through different articles they write and everything else, that trading is bad because buy and hold is the most effective strategy that there can be. The reality of it, what we tried to show you today, is that buy and hold actually, especially if you go back to the last decade and a half, has underperformed anything. There's nothing you could have done buy and hold wise that would have worked, and that would have outperformed your fees. I always talk about outperforming mediocrity. Now, of course, if you bought the bottom and sold the top, that's different. If you do try to time everything, you can do a little bit better by selling at least 25% away from highs and 25% away from lows. I do not think that's unreasonable.
That shouldn't be your goal, right? 25%?
Of course.
Okay.
Called it selling into strength and buying into weakness over a 10 or 15-year period would improve your returns exponentially. But again, let's get out of our head that we don't have to lower cost basis, that we don't have to focus on some of the nuances. I mean, imagine making a bet on a football game, even, whatever, and just say, I'll take anybody.
Sure.
Who does that? It's 9:07. We have Dave Johnson on hold, and sorry, Dave, for leaving you out to dry there. We'll be back in 2 minutes with him, and we'll have a little chat.